Hey, what's up, everyone? Welcome back to my world of stocks. As you know, we like to sometimes look at stocks that big institutions are buying, but in today's video, we're actually going to switch it up a little bit and actually talk about 5 stocks being sold. And what bigger institution could we look at for this than none other than the infamous BlackRock, the number one absolute largest asset management company in the entire world with many, excuse me, trillions of dollars in assets under management. So huge influence over the market when they're selling. It's definitely something to take a look at. And so in today's video, we'll look at their top 5 biggest sales from their last reported quarter. This is the most recent information that we have from their filings to the SEC. And I'll go through them one by one, and I'll give you my own opinion on each stock too, and let you know if I agree or disagree with this sale. So it's going to be a ton of fun, something new that we're trying out here on the channel. Please hit that like button if you want more videos like this, if you enjoy it, and that lets me know you'll want more videos like it. But yeah, let's not waste any more time because I can't wait to jump straight into this list here. So we'll be sorting these from smallest to largest sales as a percentage, and the last two, by the way, were almost complete exits. But first up here, we have a much smaller decrease of only around 2% from the popular biotech Eli Lilly, ticker symbol LLY, which they hold over $57 billion worth in the portfolio still, even after the sale. But yeah, this one I do mostly agree with, actually, with the sale, especially for being a smaller trim in size, because that tells me that this was really more so just about taking some profits from the top, as the stock has already risen by over 400% in the past 5 years, even after a recent dip. And look, don't get me wrong, there's a lot to like about Lilly. They've made several key acquisitions, with new product launches already having success for them, as they also continue working their way through their phase 3 trials in their pipeline, all leading to what should be some amazing next couple years of growth up ahead, with analysts expecting sales to nearly double in size and EPS nearly tripling too. That's incredible growth for what is already the 12th largest pharmaceutical company in the entire world. And yet there's still 3, I would say, primary reasons why I've never bought this stock myself. So I just think there's better biotech stocks out there to invest in. For example, I own stocks like Pfizer, AbbVie, Merck, and Bristol Myers, all of which are larger in size. That's reason number 1. But they're also much cheaper in valuation too, as Lilly trades 100 to 200% more expensive than the sector on PE ratios. That's reason number 2, as the rivals I just mentioned that I own myself actually trade several times cheaper than that as well. And lastly, my biotechs all pay much higher dividends too, with Bristol Myers and Pfizer yielding over 4% and 6% respectively, while Lilly only caps at less than 1% themselves. That's just not going to cut it for me on such a rich valuation like this. Again, though, not a bad stock by any means. I can see why others choose to invest in it. The company is absolutely on fire right now, which, given enough time, that valuation will drop by several times lower. But even then, it'll likely remain a little more expensive than the stocks that I own, plus with, again, a much lower dividend yield. So I get it, it's a growth oriented stock, so you can't look at it as like a value dividend play like I see the others. But all I'm saying is that I can understand why BlackRock cashed in some profits here, which look like a good move, by the way, as the stock has now started to dip back down. And perhaps they'll look to start buying again later this year because of it. I wouldn't be surprised by that either. Anyway, moving on to the next sale, we have the media giant in Comcast, ticker symbol CMCSA, which they sold about 6% of in the quarter, bringing it down to around $12 billion left in the portfolio. And for this one, I mean, it's kind of a toss-up in how you want to look at it, because on one hand, the stock has actually crashed a lot recently, falling by over 40% from the top. However, that's mostly coming off the giant upswing that they had right before that, which was riding on the wave of pandemic streaming and the rise of things like Disney Plus, while Comcast themselves were launching a competing platform called Peacock, on top of which they already owned some giant media properties like NBC and Universal, which Universal as a film studio alone actually held #1 market share in North America in 2023, even ahead of Disney, Warner Brothers, and Paramount, much of which is being used to fuel that Peacock streaming service now with added content. Plus, they even have a large theme park business too, including Universal Studios Hollywood and Florida, which have also been growing in popularity, especially after the new addition of Nintendo World through a partnership. And although a lot of their business does still go to cable TV, well, they're actually planning to spin that part of their business out into a separate company too, which would leave Comcast with a much more streamlined, growth oriented business consisting of Peacock streaming, the movie studios, and the theme parks, all of which I think makes for a pretty attractive package overall for a stock here that trades pretty close to a decade low with also a dirt cheap valuation that is around 20 to 50% cheaper than the sector on a forward P basis. And yet, I still don't want to own this stock myself. Not because it's a bad one. I actually like the moves that they're making right now, but only because I can't really see why I would want to own this one over something like Disney instead, who has much stronger brands, or even something like Amazon, Apple, or Google, who all have at least some type of exposure to video streaming. Google's YouTube actually gets more viewership than any competing platform, and yet those companies are so much larger, more profitable, and insanely more diversified. Not only being much safer, in my opinion, but also being more exciting options because of all the other things that they do as well in tech, like with artificial intelligence, e commerce, cloud computing, and so much more. But I can understand both perspectives on Comcast, so I wouldn't disagree with anyone buying or selling the stock. I just think it depends on how much value you're looking for. It's definitely a deep value type of stock right now, and honestly, kind of attractive in its own right. They even pay a nice dividend too, although I'm not sure if they'll keep it around after that spinoff. Anyway, sale number three is actually going to be a little bit different because it's an ETF, specifically the iShares EFA ETF, which they sold close to 20% of. That's a pretty big sale, about a fifth of their holding. And they now have around $7 billion left of it in the portfolio. Now, I don't have too much to say about this one simply because I'm just not a very big fan of ETFs myself. I only own one of them in my portfolio, and it's just like a broad-based dividend ETF. But this one is actually issued by BlackRock themselves, as they own iShares, and it tracks the EAFE index, which stands for Europe, Australia, Asia, and the Far East. So basically just a huge basket of like hundreds of different stocks from countries in Europe. There's Japan, Australia, South Korea, and I think even a little bit of China too. Anyway, the top 10 holdings only make up less than 14%, but the overall list includes popular foreign names like ASML, Nestle, some biotechs like Novo Nordisk, AstraZeneca, Roche, and Novartis, some car companies like Toyota, Ferrari, and Mitsubishi. I think they own SoftBank, and even the giant oil and gas company Shell. So if you wanted a lot of broad international exposure like that, well, it's definitely an ETF to consider, but I just prefer handpicking the individual stocks myself because I feel I can get better returns over time, which case in point, this ETF is only up 24% in the past 10 years. I just think that's horrible performance for an entire decade's worth of trading. Those are the type of returns that I would want to get at least on a yearly basis, let alone having 10 years to achieve such a small gain. So I'm not a fan, and I couldn't really care less what BlackRock is doing with it. But for sales number 4 and number 5, these were actually much larger drops of around 80% and 100% selling respectively. So pretty interesting. But coming in at number 4, it's unfortunately another stock here that I don't particularly care about because it's an ETF, another ETF, specifically the iShares TIPS ETF, ticker symbol TIP, TIP, which they sold over 78% of. So a giant decrease kind of out of nowhere here, only leaving less than $1 billion behind in the portfolio. Now, I will say though, at least the one interesting thing about this ETF is that it is a bonds ETF that is meant to be a hedge actually on inflation. In fact, TIPS are known as Treasury Inflation Protection Securities, which are US bonds whose principal goes up with a rise in CPI or inflation. And this ETF just basically owns a ton of those with various maturities. Now, this obviously did lead to an initial rise in the ETF when the pandemic first hit and inflation soared. However, coming off of that, the Fed had to raise interest rates by a sharp, super sharp amount to combat that inflation, which caused the ETF to crash by about 20%, is now left actually negative over the past decade. And that's because when interest rates go up, they tend to hurt bonds as new higher yields are just more attractive than older bonds, which is great, I guess, for anyone trying to time all of that, if you want to play with an ETF like this, but it's not something that I'm currently invested in myself. So I also don't really care too much about this sale either. Finishing up though with sale number 5, though, we have our only 100% decrease from the portfolio, and that is the paper and packaging company WestRock, ticker symbol WRK, leaving $0 behind in the stock. However, there is a gigantic asterisk to this quote sale, and that is that WestRock actually merged with another company called Smurfit Kappa to form a brand new, larger entity called Smurfit WestRock. And so the stock likely just converted into this new publicly traded company, which BlackRock should theoretically hold now. However, there's yet another asterisk to the story, because even though this latest decrease may not have been a direct sale by BlackRock, well, BlackRock was actually selling WestRock stock leading up to the merger beforehand too. In fact, in the previous 3 quarters, they sold over 4 million shares of the stock. So was that a good sale leading up to this merger? Well, I actually do kind of think so. Now, don't get me wrong, the merger does actually make the stock more attractive depending on how you look at it going forward. In fact, the two companies combined generated sales and profits of around 34 billion and 5 billion over the past year respectively, which I believe makes them the largest publicly traded packaging company in the world, with lots of added synergies because of it too. And while both companies already had a global presence going into the merger, well, WestRock was always, more so known for having a stronger grip on the American market, whereas Smurfit really thrived in Europe. But the two companies combined now will help them expand even more into their respective markets and beyond that too. Plus, I don't think the paper and packaging, market is ever going to stop being needed or go away as a market. If anything, I think the rise of e-commerce and globalization should send demand, rising long term, which bodes very well for the future of this new, even more dominant company in that area. However, the only issue that I see is that this does tend to be a more cyclical type of market, which we can see the direct results of in this stock's performance. It's one that is heavily tied to macro trends that can swing wildly up and down. And it just so happens that this past year was one of those major upturns, leaving the valuation pretty rich at over 60% more expensive than the sector. Hence why BlackRock was probably selling now. And although they do pay a dividend, it's a pretty small one at only around 2%. So for that, I would actually prefer international paper if I really wanted that dividend there for that market. They yield over 3%. But even then, you're also talking about the same situation of a rising stock price over the past year, leaving about the same rich valuation to go along with it. And so at those prices, I just think there's so many other great dividend value type of stocks out there that just looks so much more attractive to me. And I've made several videos about that recently. I think dividend value stocks are looking very good right now in the market. They're some of my favorite to invest in right now. But yeah, there you have it, guys. These were the sales by BlackRock. Nothing too crazy here, but I think overall, I guess I would generally agree with the sales. Let me know if you agree with them though, or if you own any of these stocks. I'd love to hear your thoughts. But yeah, thanks for stopping by. Hope you enjoyed the video, and I will have more videos coming for you soon. I'm just barely now getting over a horrible sickness that I had, so hopefully I'll start being more productive and get more videos out to you guys. But thank you for all your support, my friends. It really means so much to me. I hope you're all doing well, and I will catch you in the next one. All right, take care, everybody. Bye-bye.